So let's review chapters 10 and 12. So this first problem deals with depreciation. Right, so it says that Lincoln Company purchased a new machine on January 1st, 2019 at a cost of $150,000. The company estimated that the new machine will have a salvage value of $12,000. And the new machine is expected to be used for 10,000 working hours during its 5-year life. So there's a few key pieces there that we're going to need to pull out, right? First, when the machine was purchased. We see that it was purchased July 1st, 2019. So we're going to want to keep that date in mind. Then we care about the cost. The cost of the new machine, this new equipment, was $150,000. So that will be used when we're calculating our depreciation. Our salvage value comes into play, right? So salvage value is at the end of this equipment's life, what can we sell it for? Like if we sell it just for parts or just scrap metal, right? We could get $12,000. So we want to take note of that. And then the machine's life. We have life in number of working hours and number of years. It's going to depend on which depreciation method we're using as to which life we care about. But we'll want to take note that the life is either 10,000 working hours or 5 years. Now, it tells us that in this problem, we are going to be computing the depreciation expense under the following methods for the year indicated. So we have our straight line method, and we need to calculate depreciation expense for both 2019 and 2020. We have units of activity. We need to figure out our depreciation expense for 2019, assuming that machine usage was 1,800 hours. And then we need to use the declining balance method using double the straight line rate for both 2019 and 2020. So we take a look at straight line depreciation first. And we have our formula here, right? So the first step of that formula is cost minus salvage to equal depreciable cost. So this is where taking note of each of those individual pieces in our problem is going to come into play, right? So we need to know the cost minus the salvage. Well, we see that our cost was $150,000. That's the amount that we purchased this machine for. Then our salvage, we were told that the salvage value was $12,000. So $150,000 minus $12,000 gives us a depreciable cost of $138,000. Now that's not our depreciation expense here. What we need to do is we need to take that depreciable cost and divide it by the life in years. So how long we expect this machine to be working for us, right? And it tells us that our life is expected to be 5 years. So we take that 138,000 and we divide it by 5. So we're just going to break up that 138 over the 5 years of this machine's life. So 138,000 divided by 5 will give you your annual depreciation expense. Will be $27,600. That will be the same for both 2019 and 2020. And if I asked you what the depreciation was for 2021, it would once again be $27,600. Because under the straight line method, your annual depreciation remains constant. Now, one situation where your depreciation expense every year might not be the same would be if we purchased this machine on, let's say, December 1st of 2019. And when we record our depreciation at the end of the year, well, in 2019, we would have only had it for the month of December. So we would have to take this 27,600 and multiply it by 1 over 12. And then that would be your depreciation expense for 2019. But then in 2020, we come right back to using the full annual depreciation expense because we had the machine for the entire year. So just remember that straight line depreciation means that it's going to be constant throughout the life of that asset. Our next type of depreciation method is the units of activity method. There's a few differences here, but you can see that we're still going to start off with cost minus salvage. So for both straight line and units of activity, we begin with finding our depreciable cost. So when we take cost minus salvage, we once again get that 138,000. Now, under straight line method, we just took that 138, divided it by 5, and we were good to go. Here, there's a few extra steps. So you'll see that we take that depreciable cost, and now we want to divide it by the life in hours. Now, when we do that, it's going to give us something called the depreciable cost per hour. So if we take $138,000 divided by 10,000 working hours, we can find our depreciable cost per hour to be $13.80 per hour. So think of this as for each hour of work that this machine is doing, it's depreciating by $13.80. So we take that $13.80 and then we multiply it by the actual usage. And we were told that in 2019, our machine was used for 1,800 hours. So we say, okay, it's being used for 1,800 hours. It depreciates $13.80 per hour. We multiply those two together, and we get a depreciation expense of $24,840. Now, I said under the straight line method, if you would have purchased this in December, you would have then had to multiply that depreciation expense by 1 over 12, right? Because you only had it for that 1 month. Under units of activity, it doesn't matter when you purchased that machine. Because if we only had it for 1 month, our actual usage, that 1,800 hours, that would just be smaller, right? So it doesn't matter the number of months or number of days that you have it when doing the units of activity. What matters is just your actual usage, that 1,800 hours. So we found that our machine depreciated by $24,840 here in 2019. Now we have one last piece of this depreciation puzzle here, right? The declining balance method. This one can be a little tricky, mostly just based off of how it's described in the textbook, right? It tells you double the straight line rate. So let's just break that down into maybe a little bit more of a friendly description of it, right? So what we'll have to do first is find our book value. Our book value is your cost minus your accumulated depreciation. So our cost is still that $150,000, just like we've been using for all of the other methods. Accumulated depreciation, that's going to change from year to year. If we're working on 2019 right now, we just purchased this machine, which means it did not have any depreciation coming into this year. So our accumulated depreciation going into 2019 would be 0. So we take our cost minus accumulated depreciation to get our book value. Then you'll see this next piece here. This book value times 2 over the life in years equals your depreciation expense. That 2 over the life in years is double the straight line rate. So your straight line rate would be 1 over the number of life in years. So here we just put the 2 in the numerator, and we can just fill in our numbers for the rest. So we found that in 2019, our book value was $150,000. We multiply that by 2 over 5 because we were told that the life of this machine was 5 years. Right? So 150,000 times 2 over 5 gives us a depreciation expense of 60,000. So for the entire year of 2019, we've depreciated $60,000. Now, once again, if we had purchased this machine on December 1st rather than January 1st, we would have to take that 60,000 and multiply it by 1 over 12 to show that we only had it for 1 month. So under the straight line method and the declining balance method, you have to consider how long you had that machine. Under units of activity, that gets taken care of with just your actual usage amount. So that's 2019. If we now take a look at 2020, the idea is going to remain the same. Some of the numbers are going to be different. Our book value changes. And our book value changes because our equipment has depreciated a bit. Right? We found that in 2019, our equipment depreciated by $60,000. So that's our accumulated depreciation heading into 2020. So we take our cost minus our accumulated depreciation to get our book value. So 150,000 minus 60,000 gets us our book value of $90,000. Now, we'll use that book value in the second piece of this equation to find our depreciation expense. Book value times 2 over the life in years. So that remains at 2 over 5. That 5 doesn't change just because we're a year into it, right? It's not the remaining life in years. It's just the total life in years. So 90,000 times 2 over 5 gets us our depreciation expense. And when we multiply that out, that'll give you 36,000. So your 2020 depreciation expense is $36,000. Now, if we were to work on 2021, our accumulated depreciation would now be $96,000 because we would take 2019's and 2020, right? So we add those two together. So we would do 150,000 minus 96,000 to find our book value. And then we would just keep working through that. And you'll notice that under the declining balance method, you're going to be able to depreciate your asset heavily at the start, right? In 2019, we depreciated 60,000. Then it dropped down to 36,000 in 2020. It's going to drop down some more in 2021. and it's going to continue to decline year after year. So the straight line method, it's called straight line because it remains constant. Units of activity is when we take a look at the actual usage of that asset. Declining balance is when we depreciate heavily at the start, and then our depreciation declines from there on out. Now we can talk about the division of net income. So whenever there's a partnership, those partners have to agree on how they're going to split net income, right? So they have this thing called a partnership income sharing agreement. So in this example, McGill and Smith are two different owners. And on January 1st, McGill had $50,000 in a capital balance. Smith had $40,000. And then the partner income sharing agreement provides for annual salaries of $22,000 for McGill and $13,000 for Smith. Then interest at 10% on their beginning capital balances. And lastly, the remaining income or loss needs to be shared 60% by McGill and 40% by Smith. So we need to prepare a schedule showing the distribution of net income. First, assuming that our net income is $50,000, and then assuming that our net income is only $36,000. So we have all of that information still up in the upper left. And then we have this table or this schedule that we're going to prepare. And I just want to talk about the framework of it first. So we have our owners up at the top, right? McGill and Smith. And then we have a total column along the far right. And then along the side, we have the salary and we have interest. And then you'll see that we need to add those up for our total salaries and interest. And then we have something called remaining income. So that'll make more sense once we get to that point. And then we figure out the division of the net income down at the very bottom. So the first piece are these salaries. So we were told that McGill and Smith had annual salaries of $22,000 for McGill, $13,000 for Smith. So we'll toss those in and we'll total those up. So we see that our total obligation for these salaries are $35,000. Now for interest, we were told that the interest is 10% on the beginning capital balances. We were told at the very beginning of this problem that McGill has $50,000 and Smith has $40,000 as their capital balances on January 1st. So we take 10% of each of those. So 10% of 50,000 gets us our 5,000 for McGill. 10% of 40,000 gets us our 4,000 for Smith. Then we add up our two interest amounts, 5,000 plus 4,000 equals 9,000. Now our total salaries and interest, we're just going to add down. So for McGill, that's going to be 27,000. 22 plus 5. For Smith, 13,000 plus 4,000 gets us 17,000. And then our total amount is 44. We could add down or we could add across. Either way, we get 44,000 there. Now we come to the remaining income. So, how do we figure this out? Well, our net income is $50,000. So we need to figure out how much we have left to split up here out of this 50. So we take the 50,000 and we subtract out the 44,000. And notice that's the total salaries and interest for the two owners together. That's the total obligation for the salaries and interest that we'll have to pay out. And we see that we have $6,000 of remaining income that we can split. So we'll toss that 6,000 there under the total column for our remaining income. Now, we were told that our remaining income or loss will be shared 60% by McGill and 40% by Smith. So we'll take that 6,000 and we'll multiply it by 60% or 0.60, and we get 3,600. So McGill gets an extra 3,600 here. Smith gets 40% of that remaining income. So we do 6,000 times 40% or 0.40, and we get 2,400. Now, a way to double check that your math as all worked out here is that the 3,600 plus the 2,400 has to equal the 6,000, right? Your pieces for your individual owners have to equal the total column. Now the division of net income. Well, they have total salaries and interest, and then they get some extra remaining income, right? So for McGill, 27,000 plus 3,600 gets McGill the 30,600. So that's the amount that McGill's going to get here from this net income. Smith, 17,000 plus 2,400, a little bit less, gets the 19,400. Then we could add down 44,000 plus 6,000, or we can add across 30,600 plus 19,400, and we see that it comes out to 50,000. So the total column under the division of net income will always equal your net income amount. So we get our 50,000 there. We can just see that the way that we split up that 50,000 is that McGill gets 30,600 and Smith gets 19,400. So if we change this up a bit and say now our net income is 36,000. So instead of making 50,000 like they did in part 1 of this problem, they've had a bit of a less successful year and only made 36,000. The salaries do not change, right? This agreement showed that the annual salaries will be 22,000 for McGill, 13,000 for Smith. That's whether they make $1 million or $36,000. Then the interest does not change, because that interest is 10% on the beginning capital balances. So we take 10% of the 50,000 for McGill, 10% of the 40,000 for Smith, and we put those once again in our table here. Total salaries and interest, we just add up our columns once again. So McGill is sitting at 27,000 right now. Smith is sitting at 17,000. The total is still 44. So that top half of this table does not change even if the net income changes. Now here's where it changes. You'll notice our next line is now called remaining deficiency. That's because we don't have extra money to hand out here. When we compare our net income to our total salaries and interest, we see that we're in the negative, right? Our total salaries and interest shows that we should be paying out our owners $44,000 in salaries and interest. However, we don't have $44,000 to divide up here. We only have $36,000. So what we need to do is we need to divide up that deficiency, that 8,000, between the two owners. And we do that in the same kind of way that we divided up the positive 6,000 in the last part. So we'll take our 8,000 and multiply it by 60% for McGill, and we see that we need to take away 4,800 from McGill. For Smith, 8,000 times 40%, and we see that we need to take away 3,200 from Smith. Now, our division of net income line, we take for McGill the 27,000 minus 4,800, and we get 22,200. For Smith, 17,000 minus 3,200, so Smith is down at 13,800. And then if we add those two division of net income amounts, we'll get 36,000, which once again is our net income. So this is an important thing to remember here. McGill and Smith are not losing money here. They still made $36,000 as a company. McGill is still getting 22,200 of that net income. Smith is still receiving 13,800 of that net income. Now, they weren't able to get all of the salary and the interest and a little bit extra remaining income like they did in the first part, right? They had some money taken away from their total salaries and interest, but they are still receiving the net income here. So their capital balances would be increasing after this division of net income. You would be increasing McGill capital by 22,200. You would be increasing Smith capital by 13,800.